Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to expectations, hypotheses, theories for expected return on securities. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you would have access to it and would like to, we are in the 626 Expectations, Hypotheses, Theory for Expected Returns on Securities tab in the Practice Problems section. Closing that back out, we're going to have our information up top. We'll use that to go through the practice problem. So we have the find expected return for securities with maturities of 2, 3, and 4 years. We got our securities down below, which are going to be bonds, and the interest rates related to them. Now, one strategy that might be taken when you have something that's going to have like fixed rates, like investment accounts, possibly CD accounts, savings accounts, or bonds or something like that, is to kind of stagger the investments in the bonds so they mature at different time periods, or possibly invest in them at different time periods and be taking on then different rates. So you'll have a staggering then of when you invest in them, a kind of stair step you can kind of imagine strategy, and you'll also have the ending point when they expire will end in kind of like a stair stepping type of strategy. So then that could help you out with the kind of a liquidity, because you'll have some of these expiring at different times, which may help with the liquidity needs. And then you can also take advantage of looking at those bonds at different time periods and picking up whatever interest rate happens to be there. If we buy one, like in this case, each year out, then we can pick up the interest rate at that point in time and give a more of a diversified type of portfolio with it. So if we take a strategy like that, then the question is, well, what's going to be our expected return in that case? So we'll consider bonds here. We're going to buy one bond at the end of the first year when the interest rate happens to be 7%, another at the beginning of the second year when the interest rate is 9%, and then the third year when 10%, and then the fourth year at 9%. So then the question is, okay, well, what's going to be the expected return at any given time, given the fact that now we have this staggering process? So we're going to assume that none of these bonds are due yet. They're going to be longer than a 3-year type of period, and then see what the interest will be. Now, on the first year, obviously, the return would be 7%. On the second year, we'll basically do an averaging type of method here to kind of give an expected return. For year 2, the expected return would be the year 1 bond that we picked up at the 7%, plus the year 2 bond at the 9%. If we add those two up, we get to the 16%, and then we're just going to take the average dividing by 2, that then giving us our year 2 expected return of the 8%. So notice it would be a little bit more complicated if we had more than kind of one bond, if we had a mixing of the amounts of bonds. But if we have a set amount that we're going to be purchasing each year with these expected returns, we're basically taking the average then. So then in year 3, then we would say, okay, well, we have the bond for the first year at the 7% that we still have, that we're going to get a return on, the 9% that we're going to get a return on, and then the 10% that we're going to get a return on. If we add those up, that would be 26 divided by 3, taking the average because there's 3 of them now. And that's going to give us then the 8.67. Note that there could be rounding involved here, so we have to deal with rounding if that is going to be a factor. If you work in this in Excel, I highly recommend working these in Excel and practicing the use of these kind of percentage rates, especially when you're dividing and multiplying times percentage rates with a formula in Excel. It could be a little bit tricky just to get used to interest, the percent rate versus the decimal, and getting good at working with that. So then we got year 4, where we're going to say, all right, now we've got the year 1 bond at the 7%, the year 2 bond at the 9%, year 3 bond at the 10%, year 4 bond at the 9%. We then would have the total of those being the 35%. If we divide it by the number that we have there, that would be 4 of them. We would then get to the year 4 expected return of the 8.75. So we're basically using an averaging strategy as we think about this, for a common kind of strategy, which might be an investment strategy, which would once again be to try to stagger your investments in some type of fixed investments, something like bonds, something like maybe putting your money into a CD, a set savings account, where it's going to be locked down, and that could give you some multiple advantages, as we talked about. Putting your money in a staggered kind of way could be useful, and you could take advantage of the variability of the interest rates which will make your portfolio more diversified, and they'll also be expiring in a staggered kind of way, which might give you access to money as you need it in a easier way, rather than all of it becoming due at one point in time.